high yield, I think, has a unique spot for investors in a long-term portfolio. When you compare it to just fixed income investments, it does exactly what it's supposed to do. Over the last 15 years, it's gotten more return with a bit more volatility than, let's say, treasuries or investment-grade credit. But I think it's really interesting when you compare it to equities. Over that same horizon, whether you're talking about global equities or you're talking about U.S. equities, you've actually gotten more return from high yield with significantly less volatility. Now, I'm not making the case that investors are going to not invest in equities anymore. Investors like the unbounded upside of equities, and they also like the volatility dampening effect of fixed income. But I do think there's a place for high yield to take a portion of the equity portfolio, get equity-like returns, but with significantly less volatility. It's a very complementary asset, and I think it plays a role in most investor portfolios over the long term. One of the big challenges in the market right now is liquidity, and liquidity has been a challenge for several years, and it's really the result of regulatory changes that took place after the financial crisis. Those changes were designed to strengthen the banking system, but it did have the impact of making it very expensive to hold inventory on broker-dealer balance sheets, particularly high-yield inventory. And so what we've seen is that inventory has declined from pre-crisis about 95 to 98% today. So what have we done to deal with that challenge? Well, one of the things we've done is we've just held more cash and investment-grade securities for liquidity. But to offset the yield drag from doing that, we've also carried more triple C and single B credit. So we have a bit of a barbell. We're a little light in the middle of the double B market. But generally this has worked well to manage flows, new issues, that sort of thing. Another thing we've done is we've simply extended our investment horizon. When liquidity was better, you could have a 6 to 12 month horizon. We're now thinking more in 12 to 24 months. One implication of that is it makes credit research even more important, and we continue to focus on that as well. So yes, liquidity is definitely a challenge, but we think we're finding ways to mitigate it and deal with it effectively for our clients. Always important to take a look at where are we now. We've had a tremendous run in high yield over the last 8 months. Of course, that was a recovery from a very bad 2015 and a poor start to 2016. So where we are today at Treasuries plus 550 is very normal. It's fair. It's neither rich nor cheap anymore. But that doesn't mean we have to get overly defensive. We think that the fundamentals are still good. The U.S. economy is growing at 2+%. We think that the technical picture is actually also good. Investors looking for U.S. dollar assets are also going to be attracted to 6.5% yield in a low global yield environment. Now we're cognizant that there are risks over the next 12 to 24 months from the credit cycle being long, from the macro environment being challenged in many spots around the world. But we think this is mitigated, one, by the growth in the U.S., and two, by the ebbing of the commodity cycle. You know, most commodities have been in a downturn for more than 2 years. We're starting to see that turn around. So there are both positives and negatives out there. For that reason, we've decided that we should be more neutral, neither aggressive nor defensive in the marketplace. But in any market environment, there are always individual opportunities. We continue to use our credit research team to find those and add value for our clients.